let's just get started with a brief introduction.
All right, hi, I'm John Jennings. I am about to turn 55. So anyway, I'm from St. Louis. I went to TCU my freshman year of college, and I made a 1.8 and then a 2.4 GPA. And surprisingly, given that I was there on academic scholarship, and I lost my scholarship, so my parents yanked me. So then I went to the University of Missouri, redeemed myself, did much better, made great grades, majored in finance, went to law school, did well in law school, got a job with a big law firm in St. Louis called Armstrong Teasdale, hundreds of lawyers, where I did estate planning, like trust and estates and tax law, and speeding tickets. I kid you not. So like my second day at being this big law firm, I went to the head of litigation. I was like, where do I go to learn how to fix speeding tickets? He's like, are you kidding me? That's like the crap work that no one wants to do. I'm like, well, I want to learn. So I did. So that was great. I practiced law just for 3 years. It was, I loved law school. Practicing law I thought was it was toil. You know, it was too much, it was too hard, basically. I worked a little bit of time in a bank, less than a year. Then I went to Arthur Andersen. Raise your hand if you've heard of Arthur Andersen. All right, those are a few. Have you heard of the big four accounting firms? So Deloitte, E&Y, KPMG, PwC. It used to be the big five, and the fifth was Arthur Andersen. So I worked in their private client area where we did investments. So I was glad to get back to investments, but then also like high-end tax planning. And so I worked there, and then after 4.5 years, the firm went under. We had like 90,000 employees, and in less than a year, it went from arguably the best name in financial services to out of business. And it's because Arthur Andersen were the auditors for Enron, and you heard of Enron and the Enron thing. So the Houston office of Arthur Andersen, the partner in charge of the engagement, when he found out that Enron was being investigated, basically had a bunch of people in the Houston office start shredding documents. So Arthur Andersen got indicted for obstruction of justice, and it turned out that people don't want an auditor that is under indictment for obstruction of justice. So everybody started leaving, and it was this downward spiral, and Andersen went out of business. And at the time, I was like, this is horrible. I'm like losing my job, and all our clients are leaving, and what am I gonna do? And I had a few different job offers, but we ended up starting my current firm, which is for the next about 30 days called St. Louis Trust. We're changing our name. But we started this company. So we had this primary founder who was looking to start what he thought was going to be a boutique trust company. We are that, but we're really a multi-family office is what we do. And what ended up being the greatest thing that could have happened in my career. I got on the ground floor and helped create a company and the culture and what we do for business. And I was 32 years old when I started. And I'm not that entrepreneurial. There's no way I would have done that. And so, wow, it ended up being amazing. But at the time, I was like, this really sucks. Also, when I flamed out of TCU, I didn't flunk out, but I was close, right? I was like, this is the worst thing. I'm like so embarrassed. Like I was a good student. I consider myself relatively intelligent. What the hell? Like this is horrendous. But I went to Mizzou, met the love of my life. And as I tell my kids, if it weren't for my bad grades, those 2 semesters, you wouldn't exist. So there you go. So our firm, we are a multifamily office. We were, as I said, started out of the ashes of Arthur Andersen. Here's our secret. So has anybody read 0 to 1 by Peter Thiel? Anybody? 0 to 1? Okay. So one of the things he talks about is that every successful company has a secret. And a secret isn't just something that and others don't. It's something that that if you told someone else, even a competitor, they'd say, well, you're sort of crazy. So think about the first time I heard of build your own teddy bear, Build-A-Bear. I was like, why would someone pay 3 or 4 times to build their own teddy bear when you could just order one? Or, the concept of the first time I heard of Venmo, I was like, this is the dumbest thing I've ever heard of. Why would you take something private like your payments that you're making to someone and combine it with social media? It's ridiculous. And then of course there's Airbnb. I was like, what? You're gonna go, instead of staying at a hotel, you're gonna stay in some person's house? Insane, right? So every successful company has one of these secrets. And our secret is this. The trade-off that every business has, but particularly in financial services, is between customization and scalability. And everybody, and I mean everybody, moves towards scale. So the more assets or the more revenues you can have per unit of cost, particularly employees, office space, et cetera, the more money you make. So what you want to do is be more efficient and find ways to bring in, and if you're in investment management, more assets under management and have less unit of cost operating. Our secret is we don't want to do that. We want to be as custom as possible. I'm president of the firm. I tell our people, I would like you to do more work next year for the same clients for whom we're going to charge no more money. I want you to get more and more indispensable. So we work with 65 families and we have 65 employees. So each of our people only work with a handful of clients. And in the industry, if you're a high-end wealth advisor and you're at, I don't know, pick a big bank or trust company, if you're at JP Morgan or Goldman or Morgan Stanley or Northern Trust or Bank of America, wherever, you're typically working with 80, 100, 120, 200 accounts. Like we only have 65 accounts in our entire firm. So each of our people only work with 4, 5, 6 client families each. And every time we start to scale, we pull ourselves back. We say custom, 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 custom. And that's what we do. So we're kind of a unicorn that we only have 65 clients for 65 employees. And when we go up against the big guys, the JP Morgans of the world, the Northern Trust, we have actually a very good batting average because of our focus on one type of family. So we oversee $15+ billion. It's about $250 million per family. Our median is 190. About 80% of our clients have over $100 million. So that's really our specialty. And it was very hard as a young company. I mean, our minimums were lower, but it's really hard to say, we really just want to focus on one type of client, and we do that now. Over the past year, I've referred away people with 20, 30, even $40 million. And on their own, they would be profitable for us, but we have this really scarce resource of our people. If we're going to kind of keep this one-to-one employee to client ratio, how do we hire in qualified people, get them trained up enough so that they can be helpful in serving clients? It means that we can't add very many clients, so it means that we need to stay at a super high level. So it's super interesting what we do to work with these incredibly wealthy families and see what the wealth does for them and also what it doesn't do. And they're very complex and have tons of trusts and all sorts of investments. It's really fun. That was a longer introduction, sorry. There you go.
That is fantastic. Yeah. So we've now more a little bit about how St. Louis Trust Family Office work. So
by the way, we're going to be called Archbridge Family Office. That's our new name.
Oh.
Launching in about a month. Oh, and I teach 2 courses here at Olin in the Masters of Science and Finance Wealth and Asset Management program. And I write for Forbes, and I wrote a book. And I'm writing my second book. Okay.
So I actually just got a chance to finish the book. It was fantastic. It's all about not more technical skills, but something that's more mental models. It's another kind of the secrets that I think we are worthy to learn when we're growing up, especially starting with our own career. So definitely recommend it. I finished. Yeah, perfect. So we just talked about how finding a balance between the scalability and customization. So a follow-up question on that, we want to dig a little bit more into from the client side, as well as what is the good quality in the wealth manager. So how about just get started with the clients? So nowadays, everyone is speaking of wealth management and wealth accumulations, passing to different generations, legacy planning, etc., etc. So you've worked with a lot of clients, and what do you think most people misunderstood about wealth?
So I think people think if they get to a certain level of wealth, that they're like, oh, that's when, I'll have made it. There's a particular number. And, for some people it's like $1 million, others 10, 100 million. We had this client, we don't work with them anymore, that between they didn't have that much liquid investments, but they had, all sorts of interest in different businesses. And when that would mark to market, they were getting to where they were close to $1 billion. It was kind of wild. Like the family didn't spend hardly any money, and the family member that was in charge of the money was like, our goal is to get to the point where as a family we have $1 billion. And I was like, why? Like you don't get a plaque. And she's just like, it's just a nice goal. And they were like at like 950, right? And I was like, well, what are you gonna do then? Like, what's your next goal? And she was like, I have no idea. And she literally had no idea. And like my next book that I'm most of the way through writing, I've been researching for a decade, is on money and happiness, because I've been fascinated in seeing these families. And I will tell you, money does support happiness. That in general, the more money you make, the happier will be by a little bit. But there's some important caveats. Number one, the studies only go up to about 500 grand of income. It's a lot of money, but it's not nearly what the super wealthy have. I don't know that the super wealthy are any happier than just the very wealthy. In fact, there might be an inverted U where, once you have 50 million, I'm not sure having 100 million makes you any happier, and there's a lot of other issues that come with it. So that's number one. But number two is, while money can help support happiness, only if it's not the goal. So research has found that wanting money is toxic for happiness. Having money supports it. So what this leads to is that it'll help with happiness only indirectly. So if you do something else, like if you focus on something else and it happens that you love doing and it generates income, awesome, it'll make you happy. Like I love what I do. Like if I won, some big Powerball, I would continue to do what I do. But I know all sorts of people that their goal is money and they are miserable. You'll never have enough. Once you hit one milestone, I'm sure this family, they wanted $1 billion. Once they hit $1 billion, they're like, oh, we need $1.5 billion, right? There's always more that you want if money is your goal. And I've seen that over and over with my clients. My clients are, by and large, a happy, fulfilled bunch, but more so the people that made the money in the family than the people that have inherited. Because the people that made the money, they did something. They built a business usually, or they had some sort of career that they did something awesome. And then they happened to be rich. So that's supported by my observations and a ton of research. I don't even know what the question was. I don't know if I answered the question.
Yeah, of course. Because what probably today we're sitting here, we was wondering more than just, we're all prepared by practical skills. I know a lot of you are doing banking, doing recruiting, or just got started with your exploration in your careers in finance. And what we all hear about our peers, especially for me, all the time people are talking to me, how was your practical skills? How was your higher view doing for the 100 questions? So all of these are more technical sides, but definitely finally what leads to us in a career, and especially when we start making money, we realize that our life fulfilled is much more than that. It's really the happiness and the well-being, as well as the family, what we care. Finally will lead us to the happiness, and money isn't all of the things. So digging a little bit more into the other side, so based on your experiences, what are some of the good qualities to become a good wealth manager or a wealth advisor for the clients? Yes.
So the number one thing is to be a problem solver. That's what we do every day. We solve problems for our clients. We spot problems before they happen, and to be curious, to read a lot of different things, and then to be able to sit across from, again, I went to public high school, and then other than my very fun but failed year at TCU, then I went to University of Missouri. It's a fine school, but it's not an elite institution, and yet I'm sitting across the table all the time. We're getting people to hire me that are the wealthiest of the wealthiest, and actually most of our clients aren't in St. Louis, thus changing the name to Archbridge. In the summers, I visit clients where they summer, a verb, summer, like Nantucket, Martha's Vineyard, and the Hamptons, and I'm going to, these exclusive clubs in, Marin County up north of San Francisco, and, Santa Barbara, and all these things, and to walk in those worlds, I didn't grow up going to country clubs and things like that. It's really about, being good at what you do, having it technically, but then it's like being interesting and being well read, and I don't think they expect you to be like the exact pedigree or upbringing that they have or their kids have. It's more like, can you interact with them on a person level? And I'll tell you like our best wealth advisors aren't the ones that necessarily went to the most elite schools or had like the very best grades or the best ACT or whatever scores. It's the ones that are personable and have like the EQ skills and really listen and just care. I think it's very much a person business, and like how you make a client feel is important. And like we have almost no client turnover, and I think it's because the way we're structured to give service and the different incentives we have for our people are aligned, but it's also like all of our people really care. Like they are not profit centers, because that's not how we compensate our people. Like we hire like people that aren't salespeople. They are just they have a lot of people that come from the investment background, have like CFAs, a lot of CPAs, law degrees, finance degrees, things like that. But they aren't salespeople, and they just really care about their clients and are well-read and curious. In fact, we found some of the people that maybe were valedictorian in their high school, and we have that's too stereotypical. We have like 14 valedictorians out of our 65 people, but some of them have been so used to making A's that they don't want to fail, and sometimes it's the people that go and try new things and are willing to make mistakes and kind of own them, that tend to have the faster track careers. And sometimes we get some of our people that are so smart but perfectionist, and be like, it's okay, you don't have to know all the answers, and it is okay to make mistakes, and it's okay to do C work, because until you do the C work, you won't do the A work. So, I think that's an adjustment sometimes for, super high achievers. But there's no like direct correlation, I'd say, between, somebody's grades or, their career success, which is pretty interesting. And like all this working with these really wealthy families, like my kids are 25 and 22, almost 26 and 23, and it affected how I parented them. So my older daughter did undergrad and then master's in English, and the younger daughter's still in school. She should be graduated, but oh well. Actually goes to the University of Tasmania in Australia now, and she's majoring in art with an emphasis in object and furniture design. And like I encourage them to go do things where they could be in a flow state a lot. And I'll explain what that is if you haven't heard of it. Instead of something that is remunerative, that makes a lot of money. And that's partly from working with all these client families that I see the happiest, most fulfilled people that are the rich people I work with spend a lot, and research backs this up, are in a flow state. So a flow state is when you're engaged in something that you're completely consumed with. And it's challenging, but not impossible. And while you're engaged in it, time both stands still for you, but then it is also has moved very fast. So some people get this with like video games, right? And you look up and it's been, oh my God, 3 hours I've been playing, whatever you're playing. But you can get it with sports, you can get it with reading, you can actually get it sometimes with personal relationships. My orthopedic surgeon, I described the flow state to him, and he was like, that's why I'm a surgeon. I am in flow when I'm in surgery. He's like, some of the patients are a pain in the ass. Like, I know him socially, but he's like, some of the patients are a pain in the ass, and I hate dealing with the big hospital and the administration and the insurance, and my hours suck, and I never feel like I'm getting enough sleep, but it's all worth it because I'm in flow. And I'd say whatever you pick for a career, find a way where most of your day is in flow. And maybe that's doing big, hairy spreadsheets. I know it is for me. In fact, as I've had to delegate that, it's kind of made me sad. Like writing is for me. There's different things, but find your flow and then do that. And if you love it and you're in flow, almost nothing else matters, like how much you make, but you'll make enough. Like I was talking to somebody today that graduated from WashU a few years ago. She works at a big investment bank in New York City, and she actually wants to tried to get into wealth management, maybe work for a multifamily or single family office, and was looking for advice. And this is her work day. She gets into work at 9. And she said in her year plus that she spent at this investment bank, she's never gotten home before 1:45 in the morning. And often she's there till 2, 3, 4 in the morning. And she's like, I would like this job if I was spending half the amount of time here. But that's the amount of time and effort that she's putting into it. And she's like, nobody's investing in her because people only stay there 2 years and they're on to something else. And so she's looking to do something else. And I think, when she took my class as an undergrad, I remember like how excited she was to go into investment banking. And, like, she knew the hours were long, but now she's like, oh my God, can you imagine working that much? Like sleeping 3, 4, 5 hours a night, and then also working on Saturdays and Sundays. It's like kind of crazy. But I think it's kind of like this residency for her, and then she's going to move on to something else. And that was kind of an unrelated point, but it's just a call I had today that just comes to mind. But brilliant, like best student I ever had.
Yeah, that's a great case. It is like people are always changing their minds when they kind of move into investment banking or just different kind of careers, and started from the 2 to 3 years after that. That's probably the everyday things that's going to be started to change, and you're seeking out some new things, some fresh things in your life, and that's always the case because life is always changing.
Always. And I spent 3 years practicing law, and it was like my residency. I worked my ass off. Not like that, but I worked a ton, and I learned a lot. So after 3 years, I felt like I had 6 years of experience, and then I moved on. But I see how it's easy to get like caught up in it. I was so caught up in billing hours and bringing in clients and moving towards partner. Like it can become like a drug. And my wife was like, oh my God, like you have no personality anymore. You're boring. And I looked horrible, and I was like 30 pounds heavier than I am now. It was a bad look. But I learned a ton.
Yeah, it is. That's fantastic experience. So we're kind of wondering that when we're just talking about personality, we all have different personalities, that is, ourselves. But in the wealth management industry, how that's, when the wealth advisors gonna find the correct clients, or because we know this is a process that the clients chose the advisor, or the advisor chose the clients, because that's super interesting. During my spring break, I fly to Chicago, and I catch up with another WashU alum who worked in the Bernstein private wealth management, and then talked to him. So we did a lunch chat, and during that he said, so he told me the most successful wealth advisor is the person who can adapt his personality to different kind of the clients. So in this way, the broader group of the clients he gets, and perhaps the more successful kind of the wealth management industry and the career he has. So I was kind of really curious about how to perceive this kind of personality adaptation to different clients.
Yeah, I think you have to. You have to be careful. So I personally think like Donald Trump's an existential threat. And I will be meeting with clients that feel that way too, and they'll say something, and I'll be like, oh yeah, I totally agree with you, and we'll sit there and we'll, bash or whatever. But then I have a bunch of other clients that are like, oh, this is great. Like, he's going to do these great things, and America's going to be better, and blah, 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 blah. And to them, I just don't say anything, right? Like, I'm not going to be like arguing with clients over politics or religion or anything else. And it can be kind of hard because you kind of feel like, oh, well, am I being true to, my values to not say something? And the answer is, yeah. I mean, people have different views of the world, and you just kind of have to, you do have to adapt. And, you have, yeah, absolutely, clients that appreciate a joke. So like for some clients, I might be able to tell this joke. I'm no magician, but once I turned a back rub into 2 kids and a mortgage. But some clients would like that. Other clients would be like, oh, that's inappropriate, especially coming from the president of the company I work with, right? And so for them, maybe no joke at all, or something a little bit more tame. I don't know. So, yeah, no, I think you totally have to adapt. But also, you got to be enough true to yourself. So, like, And it gets easier as you get like more further in your career, because like if you're a junior or you're like the junior person in the meeting, it's like, no, you totally have to adapt yourself. But as you get older, like you have your own brand. Well, everybody has their own brand, but like your own personal brand is basically what people think about you or would say about you when you're not around, right? And you start from like, even before, you start while you're here, but then, going to WashU and what you major in, your grades and all that's part of your brand when you go out in the working world. But then as part of your career, you're gonna be developing your own brand. And I kind of wish at an earlier age I paid more intentional thought to what my brand is, right? But if you just stay in your office, you're not creating much of a brand. And you got to develop all sorts of things. You got to develop technical expertise, and then social ability, and then you've got to network, and then put yourself out there in a way that people think of you. And so for me, I haven't written in a while. I've kind of lost that love and feeling. But I've done this blog for years and put that out there. I've been writing for Forbes. I give speeches at conferences kind of around the country, and I go to client meetings. And so like I have this external brand, but then I have this internal brand. And my internal brand is that like I'm relatively smart. I'm like quick with things, but sort of funny and sometimes inappropriate, right? But like all that's my brand. So it's not like if I go meet with a client that I'm just can sort of completely turn that off. So yeah, sometimes do I say things that maybe I shouldn't have said? Yeah, but it's kind of it's kind of who I am. But yeah, like, and what's great is that at some point your brand starts working for you even when you're not doing anything. So because I wrote a book and I'm writing another book and I write these things, and like I have this public sort of external like brand, people think that I work really hard. And like people at work are like, oh, I know you're busy, and people are always like, oh, I'm sure you're so busy. Like the secret is I'm like not that busy, and I have a lot of unstructured time in my day. And some days, like when we built our new offices, I made sure we had a nap room. Sometimes I go take a nap during the day. But people think I'm like this really hardworking person because my brand is out there working for me. And so there's ways that you can do that. And it's almost like having money working on, you're asleep and you're not at work, but your money is generating income and growing even while you're asleep. Same thing for your brand. You like can put your brand, push your brand forward. And so writing my first book, like I had like, and I go to therapy regularly, but like with my therapist, Dr. Brog, he's amazing. But I was like, Dr. Brog, like I'm so scared to write this book. Like I hadn't started, I'm like, I feel like I've built this brand over my career. And what if the book detracts from my brand? Like what if it's not good or it's just like mediocre? And I'll give you a year of therapy. So this cost me thousands of dollars. And I'll just give it to you. He said, if you want to be kick-ass, you've got to put yourself out there and be willing to fail, which is what I tell people in our firm. And I was like, oh, okay. I need to take my own medicine. And then you do it, you put yourself out in the world, and it's hard because then you get like, some 1-star reviews on Amazon, and you're just kind of like, okay. But yeah, it's hard. But I think personal brand is really important, and to think about like how to cultivate that. And it's not just, social media can be part of it, but I think it's other things. So switching gears a little bit. We as humans have evolved to care about status. And that's because we are a group living species, and our survival depended on our ability to work in groups. But within the group determined your own survival and your reproductive success. So the higher you were in the pecking order, it's like the better mates that you got, the more genetically fit mates, the more food, the more shelter, all that. So we are wired to care about status. So we compare ourselves to others constantly. So there was a study done that said that basically 1/12 of every thinking thought is about some sort of comparison, whether you realize it or not. You're constantly comparing yourself and sizing yourself up to others. It's absolutely insane. But the way you get status is there's two ways. The first is dominance. And other pack mammals and even like ants and stuff have that. So if you're stronger, if you're more assertive, sometimes people that are dominant, you can think of certain politicians, right, that have dominance, right? And you can get that by having organizational authority or political authority. But the second way is through prestige. And prestige is doing things that other people respect that's important to the group. So you can think about, a top lawyer or a surgeon or somebody that's, think of like your favorite, blogger or whatever. They've gained prestige, right? And what's wild is like as you gain prestige, you sometimes then have dominance as you move up in the organization, right? And I think a lot of people think about the dominance thing too much. They think, I want that promotion, I want to make more money. So wealth on its own doesn't give you status, but it can give you dominance. It cannot give you prestige. So often people that have status have money because they've gained prestige or they've gained dominance, but wealth on its own is not status. So people are like, oh, I'm going to gain dominance, that promotion, that money, the this, the that, and they think that that's the way, but the better way is prestige, which is doing awesome things, and that's the great way to grow your brand.
Yeah, and to circle back, about this, I feel like being sincere to yourself and especially to your clients, and stay honest for all the time is a really good quality. And then especially just to add on the research, there's a really great way to see people are kind of grouping with similar traits and in a collective group. So usually if you're being sincere, you will find those clients who is pretty, maybe enjoy talking to you, and you will find the similar clients who have the similar traits. And there's a really interesting example. So I was talking to the same person in Chicago, and he said dogs always look a little bit like their parents. Or is that true?
I don't know. That's interesting.
So
Dogs look like their owners. Yeah, we just got a new puppy this weekend. So yeah, I don't know if he looks like me, but he's pretty cool.
Yeah. So but anyway, based on that research or study, find out. So clients will actually find a similar advisor who has a similar traits for him. So what we really gain out of this kind of the research study from natural, or just during this process of experiencing different clients and advisor, it is really important to think about being sincere to yourself, to your journey, and also try different ways and don't afraid to fail. Yes.
Amen.
Yeah, so coming to our next question, it's more related to the landscape of wealth management. So wealth management has been staying for a long time as a historical industry that started as already in financial crisis and really long history. So standing from now, how has the landscape of wealth management really shifted from the historical perspective, and what are some of the differences from nowadays when we define wealth?
Yeah, so in terms of wealth management, if you think like back in the day, so I'm talking like, I don't know, 1950s, 1960s into the 70s, if you as an investor wanted to invest, you would go through a stockbroker. So right, you're going to somebody, I mean today that those are, even though they're much bigger and broader with more services, it's like a Morgan Stanley or Merrill Lynch or Stifel or what have you. But they were, you had this person that was the stockbroker, and if you've taken, investment classes that kind of give you the history of investing. I mean, it used to be that investments were all about which stocks you picked. And in general, people would pick these blue chip stocks, right? These very high quality stocks. You buy them through your broker, and that was great. But then, along comes, I guess, probably the first thing was the capital asset pricing model that kind of looks obvious looking back, but it was like, oh, wow, as you take more risk, you get more return, right? Especially as comparison to the risk-free rate. That's fantastic. And you have Harry Markowitz, and you have modern portfolio theory. And so it's like, oh, it's not just about the blue chips. It's about picking assets that have different expected returns with different correlations. If you put these together, you get these better risk-adjusted returns, and there's no such thing as an inherently bad investment on its own. It's how it, in retrospect there is, but it's how it fits into everything else. And then you fast forward to like 1993, and you have the Fama French, and you have the factor model. And so what you can see, that progression is you're just picking blue chips to you're picking things more than blue chips, and in terms of how you're diversifying. Then you have asset classes, and then you can explain a lot of returns by factors. So if you're going to hire an investment manager, it's going to be like, are they a value manager, are they a small cap manager, or are they focusing on quality or profitability or momentum or any of these other factors? So you can see like this progression of like how the investment management industry has changed, and with it, who's providing the advice changed. So it's gone from the stockbroker, help me buy IBM or Kodak, to kind of after Kaplan and Markowitz, you start having the rise of more investment managers, right? So we're going to construct portfolios, and we're going to start comparing to a benchmark. The rise of Vanguard in 1974, and then we're going to have index funds, and over time the chipping away of active management. And so you started seeing this tilt in the 80s and definitely in the 90s away from stockbrokers to investment advisory firms. And really since the 1980s, the registered investment advisor has kind of eaten the lunch of the big wirehouses in terms of gaining more assets. And so then you have the big wirehouses, the JP Morgans, the Morgan Stanleys, competing, saying, okay, we're going to look internally more like an investment advisory firm, or the way we charge is going to change. And so then that's rolled forward. When our firm started in 2002, so coming up almost 23 years ago, because we started in June of 2002, there were some family offices, but we used to have to educate prospects about what family offices were. And multifamily offices almost weren't a thing. In fact, they were originally called multifamily family offices. So instead of MFOs, they were MFFOs, right? So when we started, we didn't even really call ourselves a multifamily office yet, even though that's what we were, because it almost didn't exist. So we rode this wave of family office and multifamily office kind of craze, really helped us in the marketing. So that's kind of how it's progressed. And again, if you go to JP Morgan, it's a lot closer now to how a registered investment advisor operates. And they'll even say, oh, we're not just going to put you in Morgan Stanley funds or JP Morgan funds, what have you. We're going to provide this more holistic advice. We're going to provide family office services. We're going to help you, fund your kids, college and retirement and all that. So it's getting to where it's harder, again, to differentiate. It was earlier in our firm, it was easier to differentiate, but it's getting where, almost no matter who you go to, they're going to say they do the same thing. And it's hard to kind of get under the cover and go, what are they really providing their clients?
Yeah, so based on that, a follow-up question would be, what are some of the key differentiators? For example, why the clients would choose your firm rather than JP Morgan or Morgan Stanley? So what are some of the key differentiators that you first meet your clients and your clients decided to put their money and wealth in your firm?
Well, I'll start with why would somebody pick JP Morgan or Goldman Sachs or Northern Trust over us? The first is they're a huge firm with name recognition. I mean, goodness. I mean, if you sell your company for $300 million and you're like, okay, maybe I had an account somewhere and I'm going to look somewhere else. If you're like, oh, I want this to be safe and secure and do a good job. I mean, why wouldn't you go to JP Morgan over St. Louis Trust or Archbridge? I mean, that's the first thing that we're battling against. So name recognition matters, and it should. I mean, they've been in business for decades or 100 years. They have all this capital and expertise. I mean, it's just, and what we say to prospects, if they're talking to somebody like that, we say, yeah, you'll do well there. They'll probably do a nice job for you. There's a reason why they're so big and they've been in business so long. They do a really good job. I mean, they do. And we say, we're just different. And what you get from us is if you go to the, doctor, we're like a concierge practice. We're more than that. We're like a private doctor that only has 10 other patients, and we only work with families like yours, and we don't sell anything, and all our people are nerdy. I mean, we're not salespeople. Everybody has these, most of our people have grad degrees of one shape or sort, and we're very good technically, and we have this structure they just can't compete with. We get these bigger firms all the time want to buy us because they want to be in our space. And they're kind of how does your average client family have $250 million? We'd love to, know your secret. And I tell them the secret. I said, the secret is, we don't sell any products. None of our people are salespeople. And we're structured in a way that you're not, even if you bought us, you destroy it. Within a year, they'd be like, oh, we'd love to have twice the number of clients as advisors, and destroy who we are. So I don't know, and we tell them the truth, and we lose clients that way. But so like if we have somebody, again, they sold their company for $300 million, they're talking to us, and I don't know, let's say it's Northern Trust, and Northern Trust is going to bring down their people from Chicago if it's in St. Louis, or maybe we're in another part of the country, and they're going to bring in like their chief investment officer, and they're going to go, oh, here's where we see interest rates heading, and here's what we think the stock market's going to do, and let's talk about the economy and all this stuff, and we're going to be able to bring you all these investments that outperform. And we, on the other hand, are going to say, we have no idea what's going to happen in the future, and nor does anybody else, and we're going to invest you like we don't know. And when it comes to public equities, we're probably just going to index you. We may do factor-weighted investments, but that behavior is probably too hard. We do have access to some pretty great private equity and venture capital. And by the way, these big firms can't compete with our private equity and venture capital because they have so much money to place. They're only going into the mega funds, and they're okay. But where you really get returns in private equity and venture capital and private real estate is with the smaller funds. Funds that have raised, are looking to raise 50 to 300 million. Where if you're with Goldman Sachs, they're not going to touch a fund unless they can allocate a few $1 billion to it, right? So we're just like, yeah, you're going to get, kind of middling private equity returns, and they're going to put you in a bunch of active managers that are going to underperform. They're going to generate a lot of taxes, and they're going to charge more fees. And once they land you, your investment advisor is going to be moving on trying to hire the next client. Whereas your principal that we put you with isn't going to have another new client for 6 years. Boom. Choose. And sometimes they choose us. Sometimes they don't. Our batting average is okay.
Yeah, that is impressive. So different clients, we would say different clients chose their advisor for different reasons. And it is that way that we can kind of conclude this about the shifting landscape to a more relationship-driven and relationship-based, rather than putting all of the tension on who gets the highest returns from a historical perspective.
And like we tell the truth, and I'll give you an example. I got a phone call, a voicemail in November, and this guy said, my name's so-and-so, I could hardly hear it. He goes, I want to talk to you about investment management. Please give me a call, in a very deep accent. So I call him back, and he's down in Midland, Texas. Does anybody watch Landman? Yeah. So anyway, Midland, Texas is the heart of Texas Oil Company. It's kind of a crappy town in an ugly area of Texas. Most of Texas is ugly. But it's the oil capital of the U.S. And so I call this guy back, and I say, yeah, I'd love to talk to you, kind of what's your story? And he said, well, I read your book, and I really like it, and I've been talking to wealth managers, and I haven't liked any of them. Will you come down to Midland and visit me? And I said, yes, but I will tell you, we only work with ultra high net worth families, like people that have, definitely above 50, usually above $100 million. Should we still talk? And he said, well, I'll tell you what. I don't know if I'm ultra high net worth or not, because so many people down here have so much money, but I will tell you this, it will not be a waste of your time to come to Midland and talk to me. So I went down to Midland, and I met with this guy, he's 71 years old. We met in a Mexican restaurant in a strip mall. We were sitting on plastic chairs at a plastic table. And he says to me, I retired about a year ago. He was the CFO of a huge privately owned oil company that had sold for $34 billion in September. And he said, I have a wife who's also 71. I'm in good health. She's in good health. I only buy index funds. I completely agree with your book. I'm going to leave everything to charity because I don't have any kids. I've set up a private foundation. I have no complexity. And we started talking. And how would you invest, this and this? And he finally asked me, he goes, hypothetically, how would you invest $1 billion? And I think he has $1 billion because he'd been at this company for 25 years, was the number 3 guy of a company that just sold for $34 billion. So I said to him, I'd invested about the same way I'd invested $1 million. We chatted about it. And he said, you know what, I really like you. I really like what you have to say. I'm going to go visit the men's room. And when I come back, I'm going to ask you, why should I hire you and your firm? So he went to the bathroom, He was pretty quick. He came back, he sat down, he said, why should I hire you in your firm? And I said, you shouldn't. I said, your problem is that you want someone to be there for your wife if something happens to you. Why would you spend the time and the money to hire a firm when you're just buying index funds on your own? And your problem with your wife can be solved by just having someone that she has met to call if something happens to you. And we'd be glad to come down and meet her or whatever. But if I were in your shoes, I wouldn't hire anybody. And he smiled at me and he said, I had already come to that conclusion, and I've met with dozens of investment managers, and you're the first honest person I've talked to. And I want to help you get business down here in Midland. And I will tell you, when he told me he was going to ask me that, he went to the bathroom, and I thought, like, what advice would I give him if he was like a relative or a close friend? And I realized he probably has $1 billion. It tested me, right? Because like at our fee schedule, $1 billion is a lot of money. And even if I greatly discount it, it's still a lot of money, right? And one of my chief responsibilities is that we have enough growth that people have career paths, and we can pay a return to our shareholders, right? So that was like really hard to do. But I did it, and I think it was the right answer. I sleep well at night with it, but it was hard. And so I told that story to my business partners and in front of our firm, and everybody was like, way to go, Kiefer. That's my alternate name. And that's like our company culture, which is like you just do the right thing, and you take care of the clients and the people, and the profits follow. And like he said, he had spoken to dozens, and he felt like he was just being sold. So, yeah, that's the hard thing, is to tell the truth when it's against your interest, and we do that a lot. And it's hard to say as an advisor because we say it all the time. Like, we don't know. Like we say, we don't know all the time. So we have clients, wondering what's going on, tariffs, and is the economy going in the ditch or over a cliff, and what's this going to do for the stock market? And we say, we don't know. And the thing is like, all the estimates coming into this year were like this, and now everybody's revising their estimates, and they're going to revise them and revise them and revise them. They don't know. And none of these people look in the mirror and go, oh my God, I'm bad at this. They continue to predict and then try to advise clients based on predictions of an unknowable future. And it's better just to say, we don't know. We're going to invest you like we don't know. And so what we say to clients is, hey, have enough safe assets, and you do. So have enough cash and bonds or whatever, and then just let it ride, because over time the stock market has gone up. I mean, could we be like we're in Japan in 1989, sitting here on a precipice of something that's going to be down for the next 17 years? Could be. We just don't know. So we're not going to give you any certainty, but have some safe assets and then let it ride. It's the best we can do. Don't try to time it. You're not going to get the top right. You're not going to get the bottom right. And like, that's good advice, but that's not what they want to hear. What they really want to hear is the guy that's on CNBC that says, we have revised our prediction for the S&P, and we're now saying that it's going to end at, I don't even know what the S&P is right now, 6,300 at the end of the year. And there's going to be, 2 rate cuts this year, and GDP, we're not going to tip into recession, so you're going to be okay. And that's going to light up this like dopamine in their brain, because they're going to feel like they have certainty from this well-educated expert who makes bad prediction after bad prediction after bad prediction. And that's hard. But it also gets us clients that are going to be good clients that don't leave us when we make bad predictions, because we don't predict. So I don't know.
Yeah. So it's still about choosing the right kind of, like, the similar people will find similar people.
Yeah, it is. It's like you find your dog. We find our clients.
Yeah.
Hopefully we found the right dog.
Yeah, it is hard because it's finally come back to psychology about also like human beings' behavior, that people are more attracted to to wealth, to kind of the status, to prestige, to reputation. And it's really important to calm down, perhaps just stay with yourself at the little cafe or in town or in bed. Just think about yourself, talk to yourself, what you really care about the most. And is it money, or you want to hear something that other people, the wealth advisor, gonna give you a really complicated, well-packaged solutions with all sort of the funds and well-returned numbers inside those package, where you really want to go together, you want to go stay with something that is more valuable. And that all depends on how we really interpret from different perspectives. For example, how do you interpret wealth? How do you really interpret and think about what's valuable for a family? And all of this sort of interpretations are made by human beings. And that's why we call human beings. We have different psychological judgment, misjudgment, and we have biases. And all of those interpretations will lead to your final actions of choosing perhaps a wealth advisor or your own career. Yeah, so we will probably have one final question, and we'll open up our Q&A session. So as someone who clearly value reading widely, a lot of books, fiction, nonfiction, investment, how have books really helped you form your long-term perspective? And not just in the wealth management, but in how you navigate complexity within your life?
Yeah, so I think like there's some quote like, not all readers are leaders, but all leaders are readers. And I mean, that's not 100% true, but I've like found that over my career, that people that are the successful people, and I don't know if like the reading makes them successful, maybe it's the type of person that is a reader that, you know, makes them successful. But I think there's a certain level of curiosity. And yeah, it's, you know, I'll tell you, like we were looking for an investment consulting partner, I don't know, like 10 years ago. And we got down to like 3 finalist firms or 4 finalists, something like that. And, you know, you get these groups, you know, 4 or 5 of them that have, you know, this analyst and this, you know, marketing person, whatever. And I'd say, you know, tell me a few of your favorite investing books. And like most of these firms, they didn't have answers. Like they'd say, oh, The Intelligent Investor by like Benjamin Graham. Again, like great book. Like I've read it. If you haven't read it, read it. It's fantastic. But that's almost like saying, oh, you know, my favorite books, I don't know, the Bible or whatever. I mean, it's like, you know, come on. Like you were probably required to read that to get your CFA, you know, and then I'd say, well, okay, well, what's your second favorite? And then like they had nothing. It's like, I'm not going to hire an investment consultant that doesn't read investment books. I mean, WTF, like what is wrong with you? Like, are you just doing this because it pays the bills, or do you love investing? And then, you know, some of the books should be like not actually totally investing books, right? And then you should be reading books about, I don't know, physics and history and politics and whatever. And then read fiction too. I mean, goodness, like it just opens up and expands your mind. And you know, I'm always, when I interview people, I ask, do you like to read? And they usually say yes. And I'm like, you know, well, what are you reading? Can you tell me a few books that you like? And the ones that light up and can answer, I'm just like, yeah, these are our people. And then other people are like, no, I don't like to read, or, oh, I do read. I'm like, well, you know, tell me a book that you read in the last year that you like. And it's like blank stare, like they don't really read. And again, maybe they go off and have a, you know, great career somewhere else, but it's not going to be at our firm. And we have a book club at work, and every quarter, and it's voluntary, so not everybody reads every quarter, but we have 1 fiction book, 1 nonfiction book that we read every quarter together. We discuss as, you know, whoever wants to show up. It's, you know, the 65 of us, there's, you know, usually like 25, 30 a time. But again, I think it's just like absolutely essential. And there's so many things that I've read in books that have just so influenced my thinking, how I view the world, particularly in the investment realm. And then it's like any one book, you're like, okay, hopefully I get one great idea or one way of seeing the world. And then once you've read 100 of those, you've created your own view of the world and how you see it. And just to like talk my book, I'm sorry, I should have brought you all copies of my book, so sorry about that. But you know, it's not too expensive if you want to buy it. But it really, what I did is I went on a search for investment wisdom, you know, kind of in the shortly after the financial crisis. And I'd always read a lot of investment books, but I was like, what's the true investment wisdom? Because what great investors do is they fall back on mental models, right? So like one of the most simple mental models is Warren Buffett's, be greedy when others are fearful, fearful when others are greedy. So and you know something's wise if it's simple but not easy. So that's the simplest advice, and it's about the hardest investment thing you can do. And it's spot on. So the book is full of different mental models related to investing that have to do with all sorts of different areas. It's like I want to collect in one place the most important mental models that I've learned and gone on a search for. And it was really originally written really for the people at my firm, because we'll hire people that are like CPAs or lawyers, and they're not comfortable in the investment realm. And it's because they're used to the black and white of the tax code or the laws or whatever. And there's so much ambiguity and unknown with investing. So I really started the book as for our people. And then I was like, oh, well, I guess I'm writing a book. And then bam. Well, it wasn't quite bam, it took a few years. But.
Yeah, it was great. Recommended, highly recommended reading the book. Around like 10 to 20 different mental models. And especially so fascinated talking about how you really navigate through the financial crisis that you started to realize about the clients and about what's the wealth management really. So we'll open up our Q&A session and welcome any questions.
Thank you for sharing.
Yeah.
I'm a junior and I'm going into investment banking. And you kind of highlighted this a little bit earlier on when you mentioned how there can be a lot of selling that occurs in other larger firms. I kind of like organizational behavior and synergies that you can notice within investment banks, or like firms. And I know that you have like a smaller firm where I think 80 or 60, or like a smaller firm that has one particular service. But I imagine that as you were being entrepreneurial and growing the firm or trying to figure out what the product was, you may have had the opportunity to like intentionally think about synergies you can create between teams, between individuals. And just, I'm curious about the process of synergy creation that you may have been able to experience or like design at a small firm that has like a very particular service.
Yeah, so like the services we provide now are a lot greater than what we did and were able to do like when we were a startup. So we have wanted to continue to hire people that add depth and then resources. So it used to be that like all our client service people were also the investment people. Now they're still investment people, but now we have dedicated investment specialists that can dig deeper and do more analysis and ask more questions, which I think provides better service. So yeah, so it's like you can hire one investment specialist that will free up more than one person's time as they're helping other people, right? As they're part of the team. And to say that we're customized and we don't want to scale, it doesn't mean that you can't find synergies and efficiencies. So we've done different things technology-wise that allows people to be more efficient. But really the goal is not, we want each of our people to work with 20 or 50 or 100 clients. It's just allows them to do more for every client that they have, and gives them more time, and or allows them at the end of the day to like have more time for themselves and more time to think. Like we don't want people to be like, I don't think people do their best work when they're running around like overworked and stressed, right? So we want to give people a limited number of clients, and I kind of think that the perfect amount of work, like work during the week, is somewhere between 34 and 45 hours. I think if you work less than 34 hours a week, that sounds very exact, but it's, I think there's, certain hours of the day that you should go and you feel productive and good about yourself. But, once you start getting much over, I'm there doing stuff and mostly focused on work for more than 8 hours a day, I think our brains get tired and we get stressed. And so what I wanted to do, again, I worked a shit ton of hours at a law firm and a big accounting firm. And so part of what I wanted to do with this company was to staff it in a way that people didn't feel like stressed all the time. I mean, they still have stress, but I want them to not feel like they're drinking from a fire hose. And as a result, we have almost no turnover among our employees. But it's hard. And I'll tell you, let me say, just because I started talking about the woman I talked to earlier that went into investment banking. I'm not saying people shouldn't go into investment banking. You learn so much. I have 2 colleagues that worked in investment banking. And like they understand businesses in a way that the rest of us don't. Like they've seen so many businesses, they've analyzed so many businesses. It's, in fact, my mentor and business partner, Spencer Burke, was head of investment banking at A.G. Edwards, and before that he was an M&A lawyer. And like I've learned so much from him. So I'm not saying that it's, you should go to investment banking because it's a lot of hours. I mean, to learn a lot, you got to put in a lot of work, and it's just really accelerated early in your career if you go to the sort of firm where you have to work a ton of hours. I'm just saying, at some point, you can get so caught up in it, in the success and the moving forward, and I want to make associate, I want to make VP, and I want to make director and then managing director, and I want to make this money and that money, that you can get so caught up in it that you lose the sense of yourself. And you got to know when to, or how to have the power to say no to that or change what you're doing with your life at some point. Because I was going down the path that that's all I was doing. And if my wife didn't make me pull the ripcord, I probably wouldn't have.
We have a question.
Hi, Professor. Thank you. Great insights. My name is Bilal, and I'm a sophomore. I have 2 questions. The first one is you talked about yourself, your law career, and about your student who went into investment banking. These long hours, how it affect your health, your personality, or your relationships. But you also get like a lot of experience. Do you think it's a good trade-off? And the second question is, how did you get your first 2 or 3 clients?
Oh, at our firm? Okay, so thank you. Good questions. When I left the practice of law, again, it was my wife saying you're boring, and it's kind of choose me or the career. She didn't quite say that. But on a Saturday, I walked around. So I was like, I don't know, when I was 28, 29 years old. And I found people around 10 years my senior that worked at this firm. And it's a great firm, great people. And I walked around on a Saturday, because they were all there, of course. And I was like, what do these people look like? What are their lives like? And I didn't want any of their lives. So many of them looked unhealthy. So many of them were divorced. Even there were some that weren't even that busy, that were just there on Saturdays reading the paper. And I'm like, why aren't you with your families, And so that was part of it. And like, I'm so glad I did it. Like, if I had to do it over, I would still go work at the big law firm. And I learned so much, and it was worth it. It was my residency, right? And I'm just really thankful to my wife that she helped me pull the report. And yes, it was absolutely worth it. But I'll tell you, over the years, not as much now because I'm older, but especially when I was in my 30s, I would have lunches all the time with lawyers that would say, I don't like what I do. Like, what I really want to do is be a history teacher, or this or that. They'd have all these things they wanted to do instead. Or they'd even say, I'd love to go work in wealth management. Like, would you be interested in hiring me? And I'm like, dude, like, you're making, at the time, you're making $200-something thousand a year, back, 20 years ago or whatever. And like, no one's going to pay you anywhere near that to do anything other than being a lawyer. They're like, well, I have a spouse, and I have a mortgage, and I have kids, and I have a dog, and like, they were trapped by it. So I'd say, make these evaluations before you set up your life in a way that you're like, to take a step back money-wise is something that you wouldn't be willing to do. Because when you're in a really lucrative career that's a lot of hours, sometimes the only thing that's going to pay you that much is doing that thing. In terms of how we get our first clients, 14 client families came with us from Arthur Andersen. We started with a running start of 14 families, $500 million of assets, and then even then we weren't profitable, but we became break even and then profitable after 8 months because a client in Kansas City that was referred to us by a lawyer actually hired us. And why they hired a startup it was crazy. Like, if that family hadn't hired us, we might not have made it. And like, whenever my clients, so we usually get hired either when somebody dies or somebody's about to or has just sold a business. Those are the most common catalysts. Probably it's the selling the business and then somebody dying. And what I like to ask these people that have made so much money, like hundreds of millions of dollars, that just sold most or all of their business, like, what do you attribute your success to? 2 of the top 3 answers, no matter what the answers are always, I surrounded myself with great people or I had great partners. And number 2, I got lucky. Like, if things hadn't happened just so, it wouldn't have happened, And it's interesting. Reid Hoffman is it Reed Hoffman or yeah? Is he LinkedIn?
Yeah.
Yeah, he's LinkedIn. So he's he went on to be a partner at Greylock, I believe, the venture capital firm, and or am I thinking of the wrong guy? Well, anyway, I might be thinking of the wrong guy, but an expert that had made all this money, building this business, didn't want his venture capital firm to invest in those businesses anymore because he realized how lucky he got, right? So even though he's an expert, he's like, if things hadn't happened just so, I would have, been toast. So.
Owen?
Hi, thank you again for talking with us. My name is Owen. I'm a sophomore here as well. I was curious, what are some of the goals that you would say, like, the happiest clients you have? Like, what are their goals that they would want you to achieve with their money? Is it more like, okay, I can pay for my kids' college tuition, or is there like any commonality between the goals of like your happiest clients?
So my clients are so rich that their number one concern, it's almost universal, is what do I do with all the money so I don't ruin my kids or my grandkids? Like that is their number one concern. You get to a certain level of money, and like you don't really need any more money yourself. Maybe you think you need more money, but you don't need any more money. And what they want for their kids is for them to be productive, and they want them to be happy. And they've seen and they're worried about what giving too much money, particularly too young, can do to them. And so there's like this thing where we have numerous clients that are leaving their kids or grandkids these like more token amounts. By token, I mean $5 or $10 million, right? And they're leaving everything else to charity. And I think if I was in their position, I would probably do the same. I think for someone living in the Midwest, somewhere between $5 and $10 million is probably the best point for happiness. That's just my own from seeing. I think once you start getting higher and higher levels, and it's different in other areas of the country, but like here in the Midwest, I think you get higher and higher levels, and it just creates more complexity, and then you tend to want more stuff. So like I have one house. Like if I had double the money I have, I might have 2 houses. And that sounds awesome, but I'd probably be better off just doing what I do now, which is like Airbnb places that I want to go instead of deal with a second house. And then we have clients that like fly private, and flying private is awesome, but there's all that extra expense and worry. And then there's isolation. So I had lunch a few months ago with a client that 2 years ago sold his company for, his family company for $300 million. And he's a little bit younger than me, he's like 50. And he plays in a band. And when he was the CEO of the company, I mean, people didn't really know what it was worth. They knew he was CEO of a company. He lived pretty modestly, a normal home in University City. They sold to a public company, and it was in the news what his company sold for. And he said now his band members treat him differently because they're all just like normal people or less than normal people financially. And like he feels resentment from them. They make little digs. He's like no longer one of the guys. And he's been feeling that in his kids' school and his social interactions. It's made him withdraw some. And that is absolutely backed from research. I see that from my clients. And you can imagine like, oh, Powerball's, $300 million, how great would that be? Think about how all your relationships would change. Think about like if you went out and you started your own company and in year 3, you were able to pay yourself $300,000, like how satisfying that would be, but yet how it wouldn't if you had won Powerball or if your family had a trust of $100 million for you. So like it kind of takes the shine off some personal achievement. And I see that with these inheritors that, like, I'd say the happiest inheritors are one that go off to be like a professional. They go off to be doctors. They go off to be lawyers. They're not like in business trying to make money, or they're teachers, or they're clergy. They're doing something else. So they've said, I'm not going to try to recreate the business success of my parents or grandparents. It's hard. It's hard to be an inheritor of a lot of money. And you may say, well, like try me. Like I think I could do it, but I'll tell you, like I do buy Powerball tickets sometimes, but it's not because I want to win. It's more this mental game I play about like how would I invest the money, and I created a lottery trust, and I'd love to battle with the IRS about it. But so there's these nerdy reasons, but I actually don't want to win because I think it would. I think it would negatively impact my life.
Samir first.
Hi, I'm Samir. I'm a sophomore, and you were speaking a bit earlier about some of these mental models and how a lot of them are very simple but difficult to act on, like knowing when to be greedy versus fearful. Another example from your book that really stuck with me was when you were talking about mean regression, and you had this friendly little vet, and this concept that's so simple can be difficult to act on for people who do all this research and think they know so much about all these different things they're looking at. And I'm wondering, given that these models can be kind of counterintuitive at times, even though they're very simple, how do you find yourself acting on those more effectively than some of the other investment managers out there?
Oh, I don't know that I do. I'll give you an example. So I'm chair of the St. Louis Symphony Endowment. We have $260 million. And there's only 7 of us, they're trustees. It's separate from the symphony. We're a separate legal entity. And I've been one of the trustees since, 2018 or 2019. And our investment performance has not been great. It's because we use an investment consultant and we only take some of their advice. And in retrospect, we've taken their bad advice and not taken their good advice. So they have had us, they put us years ago at a market weighting between domestic and international. But as the US has done better, it used to be like a 40% weighting to international was market, and until the last 2 months. At the end of the year, it was down to like 30%. And the trustees have been complaining. We're lagging. We have too much international. The US is gonna be great forever. And I've been saying, we just need to stay the course. It will come back. It's just been a long time. Same thing with our clients. They're complaining. In December or November, I finally lost and was outvoted. And we moved from 40% international to 30%. What has the international done over the last 2 months? Crushed. So yeah, but I went along with it. Like I wasn't like pounding the table because I was tired of being wrong. Like I was exhausted being wrong. For 15 years, I've been wrong about continuing to rebalance to international. Like it's so hard. I don't know, like you read these books that are like give you all this wisdom, because I read all the time, and you're like, oh, I'm gonna be better. But then it's time to go do it, and it's still incredibly hard. It's still like, oh my gosh, like the S&P has crushed everything for 15 years. Like, should we just be in the S&P? Like, and it's so hard, like, because clients look at the performance reports and they're like, oh, the S&P was up 25% last year. Why is my portfolio up 14%? Why is it up 14% when the stock market's up 25? And last year was up 25, and my portfolio was up 12%. What is wrong with you guys? We're like, diversification sometimes is painful. And they're like, it's been painful for a long time. And then you capitulate. Because you don't know. Again, we typically don't capitulate, but it's their money. And then if they capitulate and they're like, oh, let's move it to, I want 10% in international. Now international is rocking. And they're like, well, why did you let me do that? I don't know, so it's hard. So I don't know that I'm any better.
Thank you so much for coming to speak. My name is Jacob. I'm a senior here at WashU. And my question relates to building a business over time. And maybe if you could reflect on your experience and compare that with your client's experience, building businesses that serve maybe other businesses or consumers versus building a multifamily office where you're serving clients in the financial world. So could you reflect on what different maybe skill set or philosophy it takes for leading such a business and how that compares to some of your clients?
Yeah, so like I came up as an advisor, right? I started as a lawyer, then I worked as Arthur Andersen advisor. I'm still somewhat an advisor at my firm, so I've been president of the company, which I have these two amazing business partners. Our CEO is focused really on the business. I'm focused more on like how we serve the clients, but also the business. But I think that's unique, like in wealth management, where you can rise up through the ranks from being an advisor, where my clients that had businesses in different industries, there's different things. Like if it's an engineering firm or whatever, it's the same sort of concept. But sometimes they have these businesses in these different industries that they're more like a business person that had this idea. And I'd say that the ones that universally or almost universally that they become clients because they're huge successes. They wanted to make their own dent in the universe, right? They saw something that they were passionate about, and then they did it. And they weren't overly financial. There's this, if you look at the life cycle of businesses, where you start falling, so have your cycle up of of a startup and then you're mature. When you start your fall is when the company, instead of being run by the engineers, it's run by the salespeople. And instead of the people that have the ideas and are coming up with the products, it's the people that are just trying to sell. And then the next step is when they're overly financialization, when the management is spending more time looking at the profits and loss than frontline, how are our customers or clients doing, how are we thrilling them, how are we differentiating ourselves. And I see that over and over again. And the time to sell is before you become that, right? So it's like our clients that made all this money, they loved what they did. So there's did any of you own an Apple iPod? But you know what I'm talking about. Did anybody own a Microsoft Zune? You even know what that is? So Microsoft Zune was the competitor to the iPod. And when Steve Jobs was asked about the Zune versus the iPod, he said, well, we won at Apple. We made the MP3 player that everybody wanted. Because at Apple, we love music. And we built the product that we wanted to have in our own pockets. The people at Microsoft, they didn't love music like us. They just wanted to make a product that would sell. And because of that, it had no soul. And I think that's right. And I think that applies to all of business. You want what you make or what you're doing to have soul, and it's what you would want for yourself. If I won Powerball, I built or helped build it, I didn't do it myself, but I helped architect the firm that I would want to serve me if I had that money. And every day it's how can we further do that? We just hired a guy that used to be we hired him away from teaching because we realized we weren't as good as we should be in educating the next generations about wealth. We're how can we get better? We're gonna hire a teacher, right? And that was, again, looking at my own kids, if I were wealthy enough that I needed our services, would I want someone like Chris that we just hired to help teach my kids better? Yes. Or help our advisors teach them better. So it's every day, and once you lose that mindset, there's this great book called The Founder's Mentality, and it's by these guys that were partners at Bain, and it basically talks about how companies to be successful have to keep that founder's mentality. And one is that you always want to be a disruptor, and you can look at, is Apple still doing that? But they were always this disruptor going up against bigger, and that was always one. Another is that you have a obsession with your clients or your customers, so you have this frontline mindset. I forget what the third factor is, but you've got to keep that every day. And once you don't have that and you're just focusing on growth and profits, you're just like everybody else. And you've sucked the soul out of your firm, and your customers or your clients can feel it. You can feel, look at what's going on with Southwest Airlines. It's horrible. Elliott Management, which is an activist investor, got some board seats and whatever, they're going to make you more profitable. And they had trademark bags fly free. And now bags don't fly free for most people. And without warning, they took away how you earn points. They completely changed the formula. They're screwing their customers. And it's going to go from an airline that has a soul, that people were willing to be packed in line and do their crazy seat thing because they loved who they were. They're just going to be like everybody else. Why shouldn't I just, fly American? I don't know. I think it's horrendous what they're doing. And it's because the financialization happened. Elliott said, we want you to make more money in the short term, so we're going to turn around and flip your stock. And they're destroying the very heart and soul of that company. And companies do that themselves all the time. And because they want to make money for the shareholders, they think the shareholders demand it, and they focus on profits. Focusing on profits kills companies. It's what killed Arthur Anderson. Greed. Profits are a result, they are not a goal.
Yes.
Thank you for your insights.
Sure.
I'm actually studying architecture, and so my question would be, how do people from different backgrounds, how do they get integrated into onto your team, or what was it like working with people from various fields?
Yeah. So we hire mostly people that have backgrounds in tax law or finance, but so I think it's harder. We wouldn't typically hire somebody that majored in architecture unless they had a grad degree or at least a professional certification. We we do value people that have like different educational backgrounds, but it's usually somewhat congruent. Like we'll do, we do, somebody that majored in math or statistics because we're like, oh, they can come up more of an analyst, an analyst role, or, we hire, we have somebody that majored in information science because we think that that's a valuable role. But I think, there's got to be, some sort of relation to what if you're going to be an advisor, what you're going to like do with the clients. And by the way, my favorite architecture book, of course, is The Fountainhead by Ayn Rand. And it makes me question the architecture on this campus, by the way. Have you read it? Yeah. I kind of feel like the Howard Rourke buildings would be the ugly buildings and not the buildings that were made to look like they were old and like all the others. But, it always gets ranked as a beautiful campus. But I guess I would have thought it was beautiful had I not read The Fountainhead.
Yeah, I guess we'll just end up here today.
Yeah.
It was super long, longer than expected, but thank you so much for coming and
Yeah, thank you for your attention, especially since I went way over. Sorry.
Yeah, that was wonderful.
Yeah.
That's